Do you think private insurers will increasingly collaborate with ECAs? What could that mean for market capacity?
The private market can interact with the ECAs, and primarily it's on the lending side and export finance. That's generally where we see it.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast. Brought to you by Trade Finance Global.
Hello and welcome to Trade Finance Talks. I'm Mahika Ravishankar, Deputy Editor at Trade Finance Global. And today we're looking at the intersection of credit insurance and the energy sector. In a market contending with price swings, shifting geopolitics, the urgent need to decarbonise and complex long-term agreements, credit solutions are playing an increasingly strategic role. I'm joined today by Madeline Whiteley from Aon to discuss how clients are using these tools today and where the biggest opportunities may emerge in the years ahead. Madeline, thank you for joining me.
Thanks for having me, Mahika.
So to start with some introductions, please just tell me a bit about your background and your role within Aon.
Hi, yes. So I've been at Aon for 6 years now, and I've been working in the trade credit insurance space for 14. And latterly, there's definitely been more of a focus in my role at Aon with the power and energy sector and power and energy clients. And we're typically looking at single risk policies for them or small portfolios.
Thank you. And to start more broadly, how do you see credit insurance being used by the energy sector clients today? Is it primarily as a risk mitigant or can it be a growth tool as well?
Typically, credit insurance and insurance in general is seen as a risk mitigant. But more and more we're seeing it as a tool for growth. With our clients, they're really able to get a competitive edge through using better payment terms and being able to support larger line sizes with the use of credit insurance. Business can be conducted on a more broad scale. They'll have greater opportunity to branch out either geographically or to a wider spectrum of clients.
From your perspective, how's recent energy price volatility shaped demand for credit insurance in trading strategies? And thinking about the spikes that we saw in 2022.
Yeah, definitely. I mean, demand has really increased following this period, and it really demonstrated what can happen. Market volatility is real and can come out of the blue. So clients who had insurance at this time had this reassurance and could ride it out, knowing that at least a portion of their exposure was secured. And those that didn't had a much hairier time. Clients are really looking for ways to mitigate against volatility, and credit solutions should be a go-to tool in their toolbox for both the counterparty exposure and the replacement risk. Our cover is typically non-cancelable, and this was greatly appreciated during that period.
What role do you see credit insurance solutions playing in supporting the energy transition in the future?
So I think credit insurance really are here to support the energy transition and work with energy clients to provide that contingency cover. There are certainly challenges ahead within this sector that need further innovation within our market. But as long as we keep close to our clients and work to understand their needs and concerns, insurance products will evolve to support them. One example is with the growth and development of data centers. So the huge amounts of energy that these plants require is growing exponentially, and therefore counterparty exposures are only going one way. Typically, the counterparties here are strong. They're very well rated entities, but the exposures are far greater than in the usual course of business. What we see is that credit insurers are well placed to provide the structural support required to help manage those exposures and allow energy companies to optimize their trade flows. We've also seen specialty MGAs being established that focus on energy sector clients purely, that focus on carbon credits, that focus on project finance for renewables and PPAs. So these are examples of the industry directly responding and proactively supporting the energy transition with credit solutions.
Thanks a lot. That was pretty clear, and especially in terms of data centers, it looks like an interesting area to watch. I want to now talk about power purchase agreements, which are fundamental to renewable energy markets. Can they also carry long-term counterparty risk, and can credit insurance help?
So there are areas where our industry needs to work a bit harder, and I'd say long risk horizons are one of these. They are a challenge. We structure policies that give as much comfort to the client as possible within the capabilities of the market at this time. And the way we do that is building out the tenants over a period. For example, where energy companies are supplying power over a long period, there is great risk. Who's got a crystal ball that can see 10, 15, 20 years ahead, which typically these contracts are. However, insurers are extending their tenors to offer better coverage, and we've seen up to 7 years in this space. Whilst not yet being in a position to fully meet this requirement, there's every effort being made to get closer.
Hey, enjoying the episode? Tap follow for more. Done? Let's get back to it.
Cool, thank you. On that note, we've also seen export credit agencies supporting green projects. Do you think private insurers will increasingly collaborate with ECAs? What could that mean for market capacity?
The private market can interact with the ECAs, and primarily it's on the lending side and export finance. That's generally where we see it. And there's definitely a greater scope for collaboration in the market here. And bringing more capacity into the market would be no bad thing. The energy sector is the most in-demand industry, as we discovered in Aon's annual structured credit and political risk insurer capacity survey. New markets are joining and the pool is growing. We welcome innovation and increased capacity for this space.
That's really interesting to hear that the energy sector is the most in-demand market. Moving now to talk about geopolitics, which clearly plays a huge role in energy credit risk, like tariffs on liquefied natural gas, Europe's diversification away from Russian gas, even just shifting trade dynamics and tariffs, the implications that policy discussions may have on the rhetoric around energy. How are clients using credit insurance to navigate these complexities?
It is a constantly shifting landscape. Insurance can be a very useful tool for navigating this uncertain outlook. It provides stability and certainty. However, what we'd say is actually clients' buying strategies are becoming more sophisticated, and there's another angle whereby clients are using credit insurance as a tool to obtain market share too. Insurance capacity on certain names is limited and can have a material impact on trading dynamics, and getting hold of that capacity can be a real game changer.
Moving on the theme of uncertainty, we can talk about weather events and renewables integration there. In the words of Outcast, you can plan a pretty picnic, but you can't predict the weather. In your view, how should credit insurance solutions adapt to help clients manage this volatility without stifling growth opportunities?
So there are some specific lines of insurance now purely focused on weather risk, parametric insurance, for instance. However, credit insurance can still have a role too. Ultimately, as long as we can identify a payment obligation, there's an insurable risk. This could be tied to non-performance, for instance. It is all in the detail of the underlying contract. For example, we've worked on a case where the insured was holding title to the electricity produced by a renewable asset, which sat within an SPV. The insured was seeking support from the insurance market in the event that the renewable did not produce sufficient power, and therefore they need to call upon the termination provisions within their contract. This would then create a payment obligation and could be covered by credit insurance.
Thank you very much, Madeline. I want to tie up this discussion by looking forwards a little bit, asking you to predict what I've just emphasized is unpredictable. Looking across the next 3 to 5 years, where do you see the biggest opportunities for structured credit solutions in the energy sector? What advice would you give to your clients?
Gosh, I think it's a really exciting space to be in. And gosh knows where we'll be in 3 to 5 years. It sounds like a short amount of time, but we've all seen how much can happen in that sort of period. What we need to see is that insurers really stepping up to the ever greater exposure levels that we're going to see. They need to evolve to meet the needs of new technologies and support our clients over these longer periods that we've already mentioned. To energy clients, energy producers would say, be proactive, would say be strategic, ask the credit insurance question up front and build it into the business plan. We want to hear them asking, how can we use this tool to improve our competitive edge, manage our counterparty exposures, reduce the need to request collateral, and crucially, do more business. Ultimately, our product is not a tool to offload adverse risk. Insurance really works as a partnership. It's about sharing risk and being in the same boat, riding the same storms. If clients see insurers almost like colleagues, really, with the trust and transparency that comes with that, we believe the future looks bright, albeit powered by sustainable energy.
Thank you very much for that. Yeah, I guess it's a good takeaway of just ask questions and leverage the expertise of the people you work with. Madeline, thanks a lot for sharing with me today. And yeah, have a great rest of your day.
Thank you. Really enjoyed that. You too, Miniga.